Okay.
All right, guys, thank you so much for joining. My name is Prashant Kumar, and I think I'm sharing my screen. Is that correct or no? Uh, 1 second. Do you see my screen?
We see your main screen, My Realty Gains
Got
management
it.
screen.
Got it.
Yeah.
That's all. I mean, that's all we needed. We don't have anything else to share. But yes, welcome everybody. My name is Prashant Kumar. I own my company, My Realty Gains. We are apartment syndicators. Just a little bit of background about myself before I get into the real topic of today is basically, uh, let's jump onto the slide. That's a little bit difficult. Um, so I have technology background. I've had technology background, technology and management background for last 25 years. I own about 100 units in my personal portfolio. Besides that, I have been involved in about 1,500 units in GP capacity, general partner capacity in last uh, 3 years, last 5 years actually. And my competency is to remove redundancies. I do underwrite my deals meticulously. I have been exploring uh, multifamily, and in addition, I started to look into assisted living market space 2 years ago. I am, and shamelessly, I must say that I'm a mentor and I'm willing to share knowledge via meetups and social media interactions. My goal is to continue to do more syndications in multifamily and assisted living space in future. The topic, I would request you to hang on till the end. I mean, this is going to be about 20 to 25 minutes of conversation, and then I will open up for questions and answers, and I will give away some freebies, those who are there on the webinar, and we'll go from there, right? So basically, today's topic is benefits of passive investing. Okay. I hope everyone is doing great and everybody is safe with their families. We'll start from the basics and find answers to a few questions. Why should we invest in real estate? What are its benefits? And how is the cash flow generated in real estate? Right? So we are here to examine our passive investment goals, and I'm going to talk about what are the real benefits of doing the passive investing. So we should start asking again some of the questions like, is our current job is liberating us or strapping us? Are we stuck in our current job in some ways? Will our current savings enable us to sit back and just relax for future? Is it possible from our current savings or not? Or like everybody else, we wish to have second source of income coupled with negligible operations. Is that what we are thinking, to have financial freedom? So take a pause and find an answer to these questions, and you will understand that passive investing is the answer to some of these previous questions. You don't want to get involved in an investment where you become the active member. If you become the active member, you are creating a job for yourself. In real estate, passive investing relates to investing capital into a property without day-to-day landlord's baggage or property management's responsibility. So no tenants, no toilet, no trash. That's what the passive investing really means. Meaning that there's somebody else who's going to take care of all that baggage, all that work for you, and you are there to collect your equity, return on your equity. So we act as an equity partner and are there to provide funds, and we earn bulk returns on our funds. All the hassles of dealing with brokers, tenants, and banks fall on the shoulders of the sponsor or a syndicator. Syndicator is a professional who knows how to handle these bigger properties, who know how to find these investment opportunities, and who has connection in the market to find right property managers who can manage the assets. So then why should we invest in multifamily? The question is, why should we invest in multifamily when we have so many investment vehicles, right? So let's talk about it. I mean, unlike the volatile stock market, which might end up to zero in some cases, multifamily real estate is recession resilient. When we invest in real estate, we are investing in tangible assets, something which has real value, right? Moreover, we are not excessively limited by uncertainties of the market, and the rent on the property proves to be a constant source of cash flow. Another major benefit of investing in real estate is the tax benefits that it comes with. We can take an advantage of depreciation or cost segregation when we do the investments in real estate, in commercial real estate. So the point again is, yes, there are many vehicles available, like a stock market. Typically, stock market is more of a capital gain or a volatile asset. It's a paper asset, but real estate is a tangible asset, and it's always cash flowing as long as we have the tenant in the property. And additional advantage of real estate is the tax benefit that we can get through depreciation or cost segregation, right? So I'm going to talk about multifamily housing. The benefits of multifamily versus some single family investments, right? So there is an economy of scale that we achieve in multifamily, right? In a single family, your tenant leaves, you are out of rent for a couple of months. In multifamily, if you have a 100-unit apartment complex, a tenant leaves, doesn't matter. We already underwrite at 90 to 95% occupancy. So we are assuming that some people will be coming and some people would be leaving, but we are getting regular cash flow from multifamily, right? Irrespective of somebody leaving or not leaving, you're always getting a regular cash flow. That does not happen in single family investment. So you have regular cash flow. You have appreciation. Appreciation is there in single family as well as in multifamily also. However, multifamily is measured by the amount of income it is producing, not like single family. A single family home, for the same single family home, it's up to you. You may charge $2,000 rent, or you may charge $1,500 rent, but the value of the house remains whatever it is. But in multifamily, if you are improving the net operating income of the asset, you are actually improving the value of the asset, because multifamilies are measured. The value of the multifamily commercial asset is measured by the income that they produce. And the biggest advantage, which I said, tax benefit, because this is a commercial asset, you have cost segregation and bonus depreciation benefits in multifamily. I'm not a tax CPA, but I know that, at a very high level, a single family can be depreciated over 27, 28 years. A multifamily commercial asset can be depreciated over 30 years. But there are components of that asset which can be depreciated over 5-year, 7-year, 15-year period. So that is called cost segregation. We do a cost segregation study We define components which can be depreciated over 5 years. Some can be depreciated over 7 years. Some can be depreciated over 15 years. And that all depreciation can be put on an accelerated path to give more tax benefits to real estate investors. This is something which is not available in single family assets. Even if it is available, it is not that effective, right? So with multifamily, when you go into multifamily asset, you are getting the cash flow, you are getting the appreciation, you are getting the tax benefits, you have the pride of ownership. When you invest in a multifamily project, you are part owner of a project. So you do have pride of ownership. You're not owning a single family home, but you are owning, for example, 10% of a bigger building. So you have pride of ownership. On top of it, your asset is managed by professionals. Professional property manager is managing the assets. You or you and I, who are not professional property managers, do not know how to manage the asset. We struggle. We spend a lot of time. But those property managers, they manage the asset professionally. And other advantage of multifamily investing is banks are looking at those projects, because bank gives 60 to 80% money. They are lending on those projects. So they are watching us. In single family, bank give you the loan based on individuals' debt to income ratio, while on a commercial asset, bank gives you the money based on the debt service coverage ratio. Basically, bank wants to make sure that you guys are doing okay, and and the debt service coverage ratio is at least 1.25 times all the time. They want to make sure that you are not, you are moving correctly on the property. So they are watching us. They're constantly auditing us. So it is being managed professionally. It is being looked after by folks who are bigger than us, banks. And on top of it, SEC is watching, because making sure that it is not a Ponzi scheme, right? So SEC is watching all the these bigger projects, and you are owning, as a passive investor, you own part of the pie, and you are sitting, and watching everybody else to run the show. So in my mind, investing in single family meaning you are creating a job for yourself. If you are investing in multifamily passively, you are really working towards your generational wealth. Have you ever seen 15-16% return coming out of a single family project? I have not seen it. Maybe you have. If you have, that's very good. But in multifamily, uh, over a 5-year period, typically, we don't even look at the projects which are giving us return at least 1.75 times. So at least 15% of returns, that's what we look for when we get into those projects, right? 15% annualized. And basically, when we get into these projects, there is always a preferred return. Investors get money first. Money speaks first. So those who are investing the money, whether a sponsor is investing the money or an individual is investing the money, they get the preferred return typically on any project. So management's incentive is to make sure that that property is running smoothly and property is producing income, so that investors get paid first, and then they also get paid some amount, because everybody is working for money, and it's a business proposition. But because those who are investing, they have higher priority, returns go to investors first, right? So basically, we don't need to be an expert or have experience in investing to become a passive investor. These are some of the concepts which I just talked about. Anybody, for me, it is no brainer. I invest in multifamily in other syndication, and there all I need to know is the property, is good enough, and underwriting of the property has been done correctly, and I invest, and then I sit sit and watch what's going on. Every quarter I read the reports, and many times I get the check in the mail. So this is mailbox money, and when the time comes to exit from the property, I get that upside check, the bigger check, which compounded in total gives me at least 15 to 17% return. I mean, that's like the minimum. I mean, I have not seen projects where people would invest where annualized cash on cash is less than 15%. So these are some of the concepts for multifamily. Uh, let's talk a little bit more. Um, what would you prefer? I mean, would you prefer a stable 9% or a volatile 7% return? And it's no brainer. You will say stable 9%. Over the last 25 years, multifamily real estate sector has provided an average annual return of around 9%, whereas annual return from the stock market is still at 7%. This is something which I'm not talking, it's not something which I have made up. This is something which research shows. Over the last 25 years, the multifamily real estate sector has provided an average annual return of around 9%, whereas annual return from stock market is still 7%. Multifamily is a commercial project, means getting the loan approved from the banks on the income producing projects is a lot easier task, right? And additionally, we have lesser risk than paper assets like stock market. We are not the sole owner of the investment. There are multiple investors. So typically an LLC is formed, and investors are the partner in that LLC, and that LLC would own that asset. So just as returns are shared, same will losses and expenses are also distributed among partners. Um, so basically, as I said, you have the pride of ownership, right? So multifamily is typically a cash flowing asset because of the high demand of rental properties by tenants. We have seen that all millennials are going towards rental properties than owning single family homes. That demand for the rental property been has always been increasing in the last decade, right? And these projects are typically group projects, right? So we get to pick the experience and expertise of the syndicator. So there are many sponsor groups who are devoted to this particular area, and as an investor, we kind of pick which sponsor do we want to invest in, right? So I mean, that is at a very high level. There are two types of investors in a deal. One is active investor, those who are general partners, and the other is a passive investor, right? A sponsor or a syndicator may, when a sponsor or syndicator doesn't have enough liquidity, they reach out to the investors, right? So investors are the equity investors. The core job of passive investors is to provide funds for the deal. And fund can come from the sponsor also. They do come from the sponsor. We always invest in our own deals. So core job of these passive investors to provide funds for these deals, and then sit back and relax and enjoy the primary portion of the return. When I say primary portion of the return, meaning that they are making money and they are not involved in day-to-day operations. That's how it is designed. I mean, they can be involved if they want to be involved, but there is no need for them to be involved because the responsibility, the onus is all on the sponsors or on the general partners on the property managers, on the bank. All that work is taken care of by syndicator. So, I mean, overall, real estate is a great opportunity for generating cash flow, and then taking advantage of experience of these sponsors. These sponsors are experienced in what they do. These property managers, these banks, the SEC, all the professional, high level, professional insurances. So we earn, as an investor, we end up earning huge returns without compromising our day-to-day life, right? So I'm not compromising. I'm not creating a second job for me. I'm cutting a check and I'm just accepting returns. You put your money in the bank, the bank gives you 0.01%. You are actually devaluing your money because of the inflation, 3 to 4% inflation. So we have to find investment vehicles. I mean, everybody is busy, all the lawyers, big folks, everybody's busy. And if we put our money in a vehicle which is backed up by security, there's no other security better than real estate. You put your money in there and you reap the benefits of passive return. And on top of it, you reap the benefits of depreciation. That depreciation can reduce your tax liability in the long run. So these are a couple of things which I wanted to bring to everybody's attention. That's all I had to talk today. I will basically, at this point, I would ask anybody if anybody has any questions.
Yeah, Raghu here. Can I ask a question?
Sure, Raghu.
So, yeah, that was good information. Thank you for introducing the topic and giving the benefits of multifamily investment and comparing it versus single family or owning individual apartments. I think it sounds good. I want to understand a little bit more about what the interactions would be between the investor and the sponsor and the syndicator. You mentioned a few names there.
Yeah.
How is the interaction between them?
Yeah.
And that's first part. Second part is, do you get to decide which properties you want to be involved in, the location where it is? That's the second question. And third question is, do you get to be part of the decision when to exit out of it?
Yeah, so all three questions are very good. And I'll start with the second question, which is location. The property, because these are bigger projects, right? So typically, sponsor is always lookout for these properties. Sponsors look at 100 properties before they end up deciding on one, right? So it is a 3 to 4 months project typically to even find a property. Once the property is decided, then sponsor brings that property to the market and start raising equity from investors. So at that point, investors have the choice whether they want to invest in this property or not. Investor really doesn't have investor. I mean, it's just one project. You have the project. You say whether I want to invest in this project or not. Basically.
Okay.
So that's the answer to your second question. The answer to your first question is when sponsor brings the property to the market, the sponsor does a lot of webinars, talking to investors, capital raising. At that point, typically there are a lot of calls made, discussions happen. Syndicator explain everything about the property clearly to investors, and at that time, if investor is ready, investor has to review the private placement memorandum, and investor has to sign the operating agreement on which agreement of the company on which he becomes the partner. So he subscribed to that operating agreement.
Mm.
So really speaking, once investor knows that this is a deal and I want to invest in, it's a matter of maybe 5 to 10 minutes to review a document and sign it. So it's up to the investor, how much he wants to interact with the sponsor. Like, you are interacting with me. I mean, I'm also a sponsor, but there is really no need to interact. For a comfort sake, for a warm shake hand, sponsors are typically available to talk to investors as and when it is needed. So,
So, what's the syndicator's role and what is the sponsor's role?
so sponsor and syndicator are really the same meaning, same word.
Okay.
Basically,
Mm-hmm.
where a sponsor and syndicator both are same.
Okay.
So you talk to sponsor or syndicator, and then you decide whether you want to invest in the project or not. And at that time, basically, uh, you know, um, it's up to you. How much interaction do you need? I mean, you have more questions. Sponsors are there to answer any questions, basically. So one thing you have to realize that you are reviewing the private placement memorandum, a document which describes all the functioning, all the projections, everything is written in the private placement memorandum. That's something investor has in a common language talked on a webinar or something and discussed with you. But you are reviewing, and the way PPM is written, as if sky is going to fall apart and cows will not come back home tomorrow and there will not be any water or electricity. Anything that can go wrong in the world, typically lawyers write in that
Mm.
document. And the basic purpose of the document is to make investor aware that any any potential risk that could happen on a project. So, there may be natural calamity, everything, they would write. And typically, sometimes, those who are new, they sometimes get scared also, and which is
Yeah.
okay. I mean, everybody takes their time, but those who are seasoned, they know what it is.
Yeah.
And they review the PPM and they subscribe to the operating agreement. Basically, they become part owner, limited partner on the company which owns the asset. After
Okay.
that, investor's job is to wire the money to escrow company. Your money never touches sponsor's bank account or syndicator's bank account. It goes directly, investors' money directly goes to this escrow account, and that's where when the closing happens, escrow company pays it to the seller. So that is the extent of involvement from a limited partner, which is an investor. After
Okay.
that, all the work starts. Sponsor, take over the property. They start doing the work, renovation as per the plan which that they had already put together. So
Yeah.
they start with all the work on the property management company takes over, and sponsor's job is to communicate what is going on the property at least on a quarterly basis. And depending on the business plan, sponsor, issues the return to investors, either quarterly or yearly, whichever way they have decided on the project. So
Okay.
from an investor standpoint, an investor can pick up the phone and talk to sponsor anytime. And sometimes sponsors do some webinars to tell what is going on the property, quarterly or 6 month monthly webinar, something like that, to keep the investors
Yeah.
informed about the property. So
Thank you.
that's question number one. Now, question number three: what is the decision making? So limited partners do not have the authority to decide, because I mean, typically these are bigger projects, and a limited partner probably would come in with maybe 100,000, and it's a $10 million raise. So limited partners can share their concern and sponsor listen to them, but by the operating agreement, limited partner do not have the authority to exit a project. They can
Yeah.
request if they want to exit, maybe their equity can be swapped with somebody else, but they cannot force the sponsor to sell the entire project.
Yeah. Okay.
Make
But they
sense?
can get out of the investment if they need, or if they feel like it's not something for them.
If
Can they?
they may choose, they may request that,
Hmm.
they may request it, and typically sponsors try to accept that request because
Hmm.
and only in a scenario where they can swap the investor, because it is money, right? Some money has to come from somewhere.
Hmm.
So if there is another investor who's willing to come in, so sometimes they do the swap. We have done swaps in past, but it is like a CD. If you put your money in CD, you can break the CD. You may end up losing some portion of your appreciation, right? Because
Hmm.
that time, because you have not sold the property and appreciation time has passed, some appreciation has happened, but a new investor comes in, he would like to take, uh, I mean, he takes that appreciation because your share is still at 100, let's say $1,
Yeah.
right? So yeah, it is possible, it can be done, but then investor is at loss. Most of the
Yeah.
time, investor is at loss. They have gotten some return from the project
Hmm.
because of preferential return, but they have not gotten appreciation because appreciation is realized only when the property is sold.
Yeah. Yeah.
So
Makes sense.
it is possible but not recommended.
Yeah. So I'll
So
let us others ask questions.
yeah,
This
please.
anybody else?
Yeah, anybody else can ask questions, no problem at all. And these are very, very general stuff that the benefits of passive investing. One thing I should say, basically, those who are on this call, if you go to and I'm going to leave it in the chat window, basically, few things I have, those who want to learn a little bit more about, uh, a little bit more about passive investing. I've created a 7-day email course and I have a passionate passive investor club. So I'm going to leave these two links in the chat window. Um, and I think I'm still sharing my screen, right?
Yeah.
So I would leave those links in the chat window. And if you have any questions, feel free to ask.
Yeah. The other question I had was, is there a minimal amount that one would need to invest in this?
So as I said, these projects are bigger projects, right?
Mm-hmm.
And typically our raise is like anywhere from $5 to $10 million.
Mm.
And for that kind of raise, we want to keep our number of investors as limited as possible because it becomes, very cumbersome if we keep the minimum as 5,000. You can
Yeah.
imagine how much work we'll have to do to
Mm-hmm.
coordinate and all that. So typically on these projects where the raise is 5 million plus, our minimum is anywhere from 50 to 100,000.
Okay.
So that keeps the pool smaller, right? I mean, that keeps the pool. Uh, typically on a project we have about 50 to 75 investors, uh,
Yeah.
and that keeps it at least manageable. If we keep it very small, then it becomes a little bit challenging for us.
True. True. It's more
To
work also,
Yeah,
and then you own a very smaller part of the pie as well. So
right. So
right.
that's so we typically, that's what we do is we try to keep it as about 50 to maybe sometimes we do 75,000 also, like the current project that we have. There our return is I mean, our minimum is 75,000.
Okay.
So that's how it works. I mean, anywhere from 50 to 75,000. That's what I would
Yeah.
say.
So how long do you think it approximately takes the sponsor to raise the 5 to 10 million once they identify a project?
So typically that is approximately, at least 2 months worth of effort
Mhm.
for investor to raise. There, there are many bigger investors who can cut a check for 100,000. I mean, not $100,000 million, but they are investors, who just always give the minimum on the project. So yeah, it is typically anywhere from 4 to 8 weeks time frame. Uh, so so once the property is identified, it is at least 2 to 3 months to close the property,
Yeah.
right? So in that
Yeah.
time frame, sponsor actually works on trying to raise equity by themselves or through their equity partners.
Okay. Okay. Yeah. Thanks.
So yeah, so those are the things. And those who are on this call, I'm gonna send them a project that I'm currently working on, and
Mm.
maybe I can share it if everybody has 5 more minutes. I can walk them a project what we are working on currently. That way, just to give an idea of what a project looks like. Okay,
Mm.
so I'm gonna share my screen again um, right now. Share my screen. Share the screen. So again, this is confidential. This is 506B offering, and only those whom we know very well, uh, they have access to this information, um, and it cannot be forwarded to anybody else. That's just a disclaimer. If you see that we have a property, and I'm just giving at a very high level. This is 272 units apartment complex in Houston market. And basically, 100% of units in this property are in original classic condition. It's an institutional grade asset with true value add opportunities and huge management upside, right? And there's bigger floor plan. Half of the roofs are new, and it has two boilers. One is new, and property is not near the flood zone. And I'm just cutting it short. Okay, I'm not going through the whole presentation. I'm just giving you a feel of how an investment offering looks like, right? So the name of the property is Kendall Manor, 272 units. Um, you know, asset is good enough, but it hasn't been updated. The pictures that you are seeing, they are the best, the best pictures. So there are a lot of deferred maintenance on this property, and our business plan is to address the physical vacancy, uh, and to burn off lost to leases over a period of time. And we do the, you know, we do the build back on this property. We will do the upgrades of, 25% of units so that we can get at least $50 to $100 premium on those units. We will increase the curb appeal by rebranding the property, and we will do the exterior paint. And on some properties, units will install washer and dryer. On top of it, we'll have the water conservation program, shaving off, renegotiate the service contracts. And on top, and the biggest advantage is we have our property manager who's vertically integrated in this project with us, and they are going to charge us only 2% fees versus 3.5 to 4%, which are typically the scenario. So our capital expenditure is about 2.5 million, and our rents are below market. We forecast them that they will go up at least, $35, $40, $50 easily without doing anything. But when we upgrade them, they will start going, let's say from, they'll start going much higher. So our per square feet, right now we are getting like 93 cents per square feet, but chances are that we will be able to get $4 or $10 on those units per square feet. So I have some rent comps, we show rent comps in our offering memorandum, which shows that our rents are much below market as it is, as compared to the comparable properties. And basically, we have three classes of returns. One is those who want fixed 10% return, they can do that. Or class B, somebody wants 8% preferred and then the upside in the property towards the end, they can do that. But for that, minimum is 250. But typically with a 75K minimum, you have 7% preferred return. Plus at the end, you get the upside in the deal. So your return in 5 years is either 80% or 85% on your money. On top of that, you get depreciation benefit on the project, because 40% of the project can be depreciated within 5 years. So returns of about 1.8 times to 1.85 times, and then depreciation benefit. Or if somebody wants to just say, I want only 10%, that is the preferred return, it is possible on this project. So as I said, we have underwritten this property very conservatively. 2 years, our income growth is only 2%. Second is, even though we are entering at 4.8 cap, we are exiting at 6 cap, which is very conservative. A stabilized economy of 10%, while the area stabilized vacancy is only like 5 to 6%. But we are still assuming that we will have 10% units vacant. On top of it, we have $2.5 million improvement funds with lender. We have 6 months of interest reserves held by lender, and the cash reserves held by the company, about 700,000. So all in all, as I said, 3 ways to invest: class A fixed 10%, and then class B and class C, either 7% preferred rate or 8% preferred rate. And then you participate in the upside in the deal at the end. So for class A, if it is 5 years, you'll get for 100,000, you'll get 150,000. But for class B, you will get 8,000, 8,000, 8,000. But in the end, you will get another 45,000 because you are participating in the equity upside of the project too. Same thing with class C, 7,000, 7,000, 7,000, and then you are participating into equity upside. Then we talk about some projections, and I can go through these if anybody's interested. But all in all, we have done very conservative underwriting on this project, and I don't want to go through this. I don't want to bore you guys. But those who are interested, I can talk to them separately. But if you look at my exit cap rate sensitivity, I'm exiting at 6% cap. Currently, the market supports 5.5 cap. So I am very, very conservative in my mind. Even if I'm able to exit at 5.75, the return, which I'm saying 1.8 times, that will become 2.05 times easily. So if we exit at 5.5 cap, it's going to be more than 2.5 times in 5 years. So that's the sensitivity. I'm not going to spend too much time on these charts, but we have done the stress tests. It would take approximately 27% vacancy to basically keep our debt service coverage ratio to 1.5, or 40% economic vacancy to be able to pay the mortgage back to the lender I mean, these are very, there's the stress test that we did, just to see how it would look like. So this is our capital stack: loan proceeds, Class A, Class B, Class C. We have purchase price, capex, closing cost, and then cash and loan reserves and working capital. Investment summary, you have third-party property management fees is 2% of the income. Asset management is 2% of the total income. There is acquisition fees of 2%. So the sponsors are just making acquisition fees of 2% upfront. And in the end, they are making 30% split, 70-30 split basically. So in the upside, sponsors do get 30% because they need to make some money too to survive in this business. The sponsors, the general partners will make 30% and 70% will be given to investors. So yeah, this is a new financing, 5 to 7 year hold. You have 10% equity with a 14% IRR or 8% Class B. So all these numbers we just talked about. And on top of that, you have the tax savings basically for investors. So if you see here, our cost segregation will give us 5 and 7, 12, 13, 14, about $14 million in cost segregation in the depreciation that can be taken in the beginning. I mean, from year 1 to year 6, all of them. So these two depreciations can be taken in year 1, but from year 1 to year 6, another 7 million can be taken as depreciation benefit. So this advantage is available only in commercial asset, not in residential asset, and that can reduce your taxes, considerably. So why do I like this property? It's an institutional grade asset. 100% of units are in their original classic condition. It's a highly desirable Class B. Location close to everything. Very close to the airport in Houston, Texas. Ample job opportunities, Amazon, HP, Toyota, you name it. A median household income of 57K in 5 miles. Very big floor plans, and the sponsor team is very, very experienced, vertically integrated, about 4,000 units under ownership and management. So that's how we do the presentation. That deal is going on right now, and we plan to close it not May 27th, it is April 30th. So we have about 20 days to close this deal. So this was not the sole thing that I wanted to talk about. The real purpose of this webinar was to talk about the benefits of passive investing for our listeners. So yeah, that's all I have. Anything else I can answer, Raghu or Nemo?
No, I'm good. Thank you very much.
Very good.
That's helpful information.
Yeah. As